makers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. UBS, one of the biggest gainers on the stock 600 today after a group of centre-right Swiss lawmakers proposed a compromise on its capital requirements. It centres on allowing the bank to use more convertible bonds to meet its higher future requirement. Joining us now is Bloomberg's Laura Noonan with the details. How far then, Laura, does this go to address the fears that UBS will have to raise a lot more capital?
So I would say, Tom, it is certainly positive news because what it indicates is that the Swiss government, having started at this very, what UBS would call an extreme proposal, $26 billion of high quality extra capital, is now moderating its position. So the detail of what we learned yesterday was that a big part of that proposal is about the backing for foreign units. They wanted $23 billion. Now they're saying that the proposal is that half of that could be met through AT1, which is a cheaper form. And to give you a sense of the cost, AT1 can cost between 6 to 8 or 9%. Equity costs around 10%. So it could be cheaper for them to do that bit. What I would say is there's a very long way to go in this. So this is positive from a signalling perspective, but still you're talking about a lot of extra capital, and this is far from done.
And well, to that point, Laura, and of course Sergio Ermotti, the CEO, has been outspoken on this question. Will this be enough, do you think, to address UBS's own concerns about these increased capital requirements? Will they accept this?
So we're not yet at the point where they have something to accept. So it's going to be probably towards around September 2026 where we have a final proposal, which then has to be trashed out a little bit further. So we're not yet at the stage of them saying, OK, this is enough for us to stop exploring ways to mitigate the impact of this. This is certainly does indicate that things are moving in the right direction. And if you think of the range of options UBS has from here, I think this does chime with their hope that we would get to a place where there's a compromise and they don't have to do anything drastic like moving the headquarters out of Switzerland or like having to separate their bank. So we are a way away from them looking at this saying, OK, can we live with this? Are we definitely going to keep our current business in the current place it's in? But it definitely makes it more likely that we will have a less extreme solution from UBS in terms of fundamentally changing the shape of their business.
OK, and the stock is up just shy of 4% right now. Bloomberg's Laura Noonan, thank you very much with the details on the UBS capital requirement story, a story that will continue to evolve, of course. To the tech space right now, Broadcom shares falling, as we mentioned, after its sales outlook for AI revenue failed to meet investors' pretty sky-high expectations, quite honestly. The company has a backlog of $73 billion, 73 in AI product orders that will be shipped over the next 6 quarters. But in a conference call with analysts, the CEO said he could not give a revenue forecast for 2026.
It's hard for me to pinpoint what 26 is going to look like precisely. So I'd rather not give you guys any guidance. And that's why we don't give you guidance, but we do give it for Q1.
Meanwhile, President Trump says the US is willing to contribute assistance to Ukraine as part of a security agreement to end the war with Russia. But he continued to express frustration with the pace of talks. This as Volodymyr Zelenskiy floated the prospect of allowing Ukrainians to vote on handing the Donbas region to Russia. Bloomberg's chief Europe correspondent, Oliver Crook, who followed this for us, of course, is at the European Council in Brussels today and joins me now. Talk us through what we heard from the US President, Ollie, and to what extent it moves this whole process forward or not.
Well, the parts about his impatience probably don't move the process forward any more than they already have been. The sort of urgency that he's sort of producing, saying that he wants a deal by Christmas, that's not terribly new. But we have seen the Americans bring a lot of pressure to bear on both sides of this in order to get everybody to the table. What we did hear from President Trump, which was relatively new, was an open talk about security guarantees for the Ukrainians that the United States would participate in some form or another. It is not something that Trump tends to talk a lot about. It's something that's obviously absolutely key for the Ukrainians. He did not elaborate any further in saying what those security guarantees could actually include, but I think the Ukrainians and the Europeans would consider it progress that he's openly talking about it. He also talked about potentially sending an American delegation to talks in Europe over the weekend, but he said that he would only do so if he thought that meaningful progress would be made and that he wouldn't basically waste his time for meetings just for their own sake. I think the most interesting thing, Tom, that we got over the last sort of 48 hours, though, is from Volodymyr Zelenskiy, the president of Ukraine, who has now basically been trying to adapt his strategy since February to basically this concept that nothing out of Washington, D.C. is a bad idea. So even when you get something very, very controversial, like wanting to hold elections in Ukraine during the war, Volodymyr Zelenskiy says, fine, no problem. We will do it in 60 to 90 days if the United States can secure the territory, can secure the conditions within Ukraine to hold those elections. So something that the Trump administration has criticized Zelensky for, he is now using the momentum of the Trump administration in favor of trying to get those security guarantees. The second thing, Tom, is the one that you mentioned there, is a referendum potentially on handing over part of the Donbas to the Russians in any kind of peace agreement. This is something that Zelensky has been very reticent to agree to. This is something that he's basically refused. But putting it up to a vote to the population of Ukraine, one, basically makes it a democratic choice for the Ukrainians. If they say no, it's not Zelensky saying no, so the Trump administration can't really blame him. And it also puts on display that Ukraine is a democracy. So this is a sort of really clever way to use some of that pressure in his own favor and actually try to advance the peace negotiations.
And Ollie, EU ministers are meeting today. How close are we to finally freeing up those frozen Russian assets? There's been a lot of push and pull on this, with of course Belgium at the centre. This is needed, desperately needed for Ukraine. Is there any progress on that front?
So I'd say there are two kind of major hurdles. The first is this question of keeping the Russian assets frozen. That requires unanimity, and it's always a big song and dance with the Hungarians and the Slovaks whenever there's a vote for it. Now what the European is doing is going to enlist emergency powers. They likely are going to do that today to basically freeze the assets indefinitely by circumventing the total majority and going to a qualified majority. It's a bit of in the weeds kind of baseball for the Europeans, but it's actually a very meaningful step, and it's something that's obviously going to upset the Hungarians pretty substantially. That is expected today. That brings us to next week, which is the issue of Belgium. They still have not stated unequivocally that they are happy with the reassurances that the Europeans have provided. We still have not got that clarity. That being said, Tom, we are getting increasingly positive signals from other European leaders, so hopefully it's something they'll be able to pull the trigger on next week. If they fail to do so, this of course would add another humiliation to the Europeans and their ability to exert geopolitical influence on the global stage.
Bloomberg's chief Europe correspondent Oliver Crook in Brussels. Thank you. Now, as we look ahead to 2026 and investors explore areas offering some of the biggest opportunities, our next guest says a durable theme throughout next year lies within emerging markets. Joining me now is Luis Ordóñez, head of global macro research at JP Morgan. Luis, thank you so much for coming to the studio this Friday morning. Let's start then with your outlook. We'll get to the EM space, and part of that ties into your call around the dollar. But let's start you on your broad outlook for the global macro economy. And on a day when we're seeing record highs again for global stocks, you look ahead to 2026. How constructive are you on the backdrop, the economic backdrop globally?
We have to be constructive because we think that this resilience of growth that we have seen globally in 2025 is probably going to continue into 2026, with growth in the U.S. remaining around 2%, EU around 1.5%, China between 4 and 5%, EM as a whole, excluding China, 3.3%, staying flat. It is quite lopsided. We know that a lot of that relates to these, massive investments in AI-related data centers and the like. But so be it. The headline is being kept quite healthy, and that is, I think, what is explaining the market reaction. Yeah, and indeed. And we have to factor in stimulus as well. Stimulus from the U.S. in the form of the so-called One Big Beautiful Bill, the tax cuts from the U.S. administration, which really kick into gear next year. Yes. Potentially support as well from China, maybe not as much as some in the markets had hoped for, but some continued support given the challenges in the real estate sector. What is the multiplier effect of that additional support coming through from the U.S. and China next year? For sure, it's part of the equation. So for the U.S., we have seen the consumer that even though inflation there's been an uptick in inflation, you have not seen really, and there's been a decline in a hit to consumer confidence. You have not seen a big drop in consumption in the U.S., partly potentially helped by the wealth effect, having markets at the highs, right? And you mentioned China. China has now this pattern that the first half of the year is strong, the second half of the year is weaker. The Chinese react by announcing more fiscal stimulus. That does help the first half of the following year, right? So now we have very strong growth in the first half of 2026 penciling for China and weaker second half. It is possible. Overall, we have 4.4% growth in China for next year, down from close to 5% this year. But they can certainly announce more fiscal stimulus, so they may come to the rescue once again.
On trade and on China, a line just crossed on the Bloomberg terminal in the last few minutes saying that China plans to impose export licenses on some steel products from January the 1st. We don't have the details yet as to what those products are, but it's a reminder of global trade frictions that continue to be there. Yes, Europe has weathered that quite well. There's been surprising resilience. Is that a story that we can put to bed for 2026, or is it a risk that rears its head again?
I think it will raise its head again. I mean, I travel a lot for work, and I can tell you around the world, be it India, be it Brazil, Turkey, Colombia, everyone is complaining about all these cheap exports coming from China, competing with the local manufacturing. We have seen overnight in Mexico announcing some tariffs on Chinese imports, right? And I think that, we have to see probably more reactions here in Europe and around the world. It's very tricky for countries that do export a lot to China to impose tariffs and put restrictions. But I think that the pressure, that deflationary pressure that is generating around the world, maybe it's a good thing for controlling inflation, but it's hitting manufacturing sectors around the world. And there's going to be potentially a political pressure on governments to do something about it.
So what does that deflationary pressure then mean for central banks? We have a Bloomberg survey today suggesting that most economists actually expect the next move from the ECB to be a hike, not a cut. Not in the immediate future, a couple of years out. But if we get this deflationary impulse from China coming through substantially, does that mean that, in fact, we have to rethink how far central banks have to go on rates?
Well, potentially, but I would say, though, that is going to, the deflationary pressures, at least for the developed world, is probably going to limit the need to hike. What you're alluding, right? In the case of EM, it will allow central banks that are still keeping high rates to potentially cut. And that is one of the arguments for being positive in EM local markets that we can discuss in a minute. So I think that deflationary pressures coming from China are real, and they're going to continue to at least provide in many places a benign contention of inflationary pressures.
So unpack that call then, because you're constructive. In fact, you say you're overweight emerging markets versus developed markets for next year. Yep. Why? Part of that is down to rates.
Part of that is down to rates, because we still have, the inflation issues that we're discussing is mostly actually concentrated in the U.S., right? And that is partly because of the pass-through from all these tariffs onto consumer prices, right? It hasn't been as high as we feared, but it is there, and it probably will continue, right? Our economies have a peak of inflation in the U.S. around 3.2, 3.4, sometime during the course of 2026, right? So exceeding the we're at 2.9 right now, give or take. But in EM, we have seen a deflationary trend, which is probably going to continue, and that is going to be allowing EM central banks, at least those that either haven't cut so far too much or haven't even started cutting, I'm putting a country like Brazil there, to start cutting during the course of 2026. So I think that one of the ingredients of why we're constructive for EM is that, we have inflation contained, is still well behaved. We have central banks working in the direction of cutting rates. Of course, the Fed, we're expecting one last cut late January. It now remains to be seen, given the messages from the FOMC this week. But we still bake that into the positive view for EM local markets.
And when we think about the US then, you touched on the Fed, and they've touched on it, they talked about it, the FOMC was the AI spend, which you mentioned as well. Does the spending momentum on AI infrastructure continue into 2026 or start to moderate?
We think that it still continues. So our team has done a bottoms-up analysis of how much CapEx related to AI there is in the pipeline. They come up with a number which is amazing, $5.3 trillion of pipeline between now and the end of the decade, basically the next 5 years. So you're talking about give or take around $1 trillion per year. Yeah. The U.S. economy is $30 trillion, right, nominal GDP. So you can tell that this is huge stimulus that is going to keep, I think, growth at a very decent pace. We can discuss about, how much the market has already priced it in, and there's all this talk about potentially bubble dynamics building up. But the reality is that with this strong pipeline, it is unlikely that this is going to reverse or come to a sudden stop just yet in 2026. I think that we need to start worrying about that. I don't know if it's 28, 29, but certainly not next year.
If you're looking for a hedge, you favor gold, $5,000. What gets gold to $5,000 per troy ounce?
Well, you have a continuation of a factor that is a well-known one, which is EM central banks, DMEM, around the world diversifying away from the dollar, geopolitical reasons, risk management, geopolitical uncertainty, you name it, is driving that. But beyond that, you're seeing that asset managers around the world are also, jumping into the trade, buying more gold through ETFs. We see a lot more demand for physical gold as well. And the one thing that has really moved the needle this year is that in February, China allowed its massive life insurance companies to invest up to 1% of their AUM in gold. They're probably, it's only a fraction that has already happened this year. There is a lot more coming up. So we think that 5,000 is in the offing by the end of 2026. Okay. And we can certainly see 6,000, I don't know if 2028, 2029. So that's the pattern.
Wow, okay. 6,000 is a target further out. Luis, thank you very much indeed. Luis Ordóñez, Head of Global Macro Research at JP Morgan, favouring EM over DM for 2026 in terms of equity markets, with that view in gold, 5,000 by the end of 2026 per troy ounce. Coming up, China's exports continue to go from strength to strength. The point that Luis was making, of course. Can Europe do anything to slow the threat? We're going to discuss that next. This is Bloomberg. Welcome back to The Pulse. China's exports are posing a greater threat to Europe's economy, with French President Emmanuel Macron calling the trade imbalance unbearable and European Commission President Ursula von der Leyen saying the EU's ties with China have reached an inflection point. This comes as data this week showed its trade surplus with the EU, China's trade surplus with the EU, widened to $300 billion. Joining me now is Alicia Garcia-Herrero, Chief APAC Economist at Natixis. Alicia always has a keen eye on the trade imbalance question. Alicia, we have been talking about the trade imbalance vis-à-vis China and its partners in Europe, but also the US, other parts of the world, for many a year. What changes? What is different now? Why is the risk more stark?
I think what is different is that the same number, $1 trillion, which we already had last year, is becoming more unbearable following Macron's words, because we don't really know how structural this is. So, we could have told, well, post-COVID or, you name it, a lot of reasons related to cyclical. But by now, we cannot say that. I think by now, what we really need to know is how much is productivity differential, so basically China becoming more productive, more innovative, moving up the ladder, and how much is, and this is the IMF view, we just heard it, actually external competitiveness based on a weak RMB, stubbornly weak RMB, and price differentials, i.e. China pushing deflation, slashing prices to export its way out compared to, normal inflation trends in Europe, let alone the US. So, that is the key. Because if it's the latter, instruments can be thought through. The US already has currency manipulation instruments. Europe doesn't have any. So is that the way to go? But before we need to know, because maybe we're missing the target. Maybe it's just productivity gains from China. Then we should just speed up our innovation and move without caring about that now, just focus on ourselves. But if it is the latter, we need to focus on China. So that's why this question is really important.
Where do you land on that question, Alicia? I mean, can you not make the case that it's arguably a bit of both?
Yeah, it is a bit of both. And we are trying to figure out how much of it. But let me give you one number, which is quite striking. The Eurozone, so if we focus on Euro now, has actually lost 35% external competitiveness when you just look at the Euro development versus the RMB since 2020, and the producer price differential, which is much bigger than CPI, but that's the one that matters because that determines export prices. So, in that regard, I actually think that the external competitiveness part is important. It's not all about China becoming amazingly able to compete on the front end, which is also true, but I wouldn't say it's everything. So in that regard, we need a response, if you ask me.
How do policymakers, how do investors weigh the deflationary dividend, though, from that export impulse of China versus the trade tension risk?
Yeah. Well, we are a little bit tight on what we can do, not only because so much China is a big market for us. It used to be an amazing market for Germany. It isn't anymore. Exports fall at double digits. So, if they fall a little bit more, that's not the end of the story. But the problem is our imports. We depend on China on a number of things at 100%, whether it's, pharmaceuticals, some, of course, rare earth, which is even more important. So the problem is, can China strangle our economy? And that's why I think we have to be very careful with the response. We have a toolkit, everybody knows, anti-coercion instruments, you name it, but we can't use them because we indeed fear that coercion. Yes, so the weaponization of China's strategic dependencies that Europe has been building. So we actually can only respond on a coordinated manner. And the problem is the US is not there. So that's it. That's why we can't do much.
What? On the other side of this equation, Alicia, into 2026, for European companies exporting to the Chinese market, what is the domestic consumer strength going to look like next year?
I'm not counting on that, no matter, the China Economic Work Conference that just finished, where, again, we have this first objective, domestic demand, but we heard that last year, we heard that 2023, so I'm not expecting much on that end for a very simple reason. If you take out net exports out of China's growth, China would be barely growing 3.5%. So, what do? China cannot afford more imports because that reduces the contribution of external demand to growth. So no, don't expect too much on China from the import side. Yeah.
Alicia, thank you, as ever. Alicia Garcia-Herrero, Chief APAC Economist at Natixis. Coming up, we're going to do a deep dive into the metal space. Copper, oil, in focus. Stay with us. This is Bloomberg. Good morning. Welcome to The Pulse. Happy Friday, everyone. I'm Tom Mackenzie in London. These are your top stories. UBS shares jump as Swiss lawmakers float a compromise to help it meet higher capital requirements. Nvidia-rival Broadcom disappoints with a sales outlook that fails to meet expectations and a non-existent AI revenue forecast for next year. President Trump says he would be willing to help with security guarantees for Ukraine, as President Zelenskyy says a deal on conceding land could be put to a vote. Let's get to the commodities space now. We'll bring you some analysis. A pretty interesting time when it comes to oil, gold and copper. Talking of copper, hitting a fresh record on fears of tightening global supplies, the industrial metal now on course for its third weekly gain. A little softer in the session today, but the run-up clearly has been there, breaking through those fresh record highs, closing in on $12,000 per tonne. Let's bring in Michael Haig, Head of FIC and Commodities Research at SocGen CIB. Michael, good morning. Let's start on the copper story. Is it looking overstretched at this point?
I don't think so. I mean, there's a lot of things that are going in support of the demand side. You just mentioned the supply where we've had some constraints, but if you think about the demand, we've had the traditional demand, we've got green transition demand, but you have to add on top of that data centers, stockpiling, defense spending. There's lots of things that are going on that could create even more of a deficit in the copper market.
That's interesting because the bears in the copper space, and many of them have been washed out at this point, but the side of that view that I've heard is that the foundations are not there, that a lot of this is around a bet on tariffs in the US. You've seen all those shipments into the US market on expectations that Trump may put some tariff in, and that's distorting the market. The fundamentals are not supporting the upside. You disagree with that? Do the drivers that we're seeing now push back on that maybe, and then explain what you see as the drivers into 2026 for this industrial metal?
So with the tariffs that are going to be renewed again or revisited in the middle of 2026, obviously that causes jitters. You get these dislocations around the world. copper being moved from one place to another. So that's not really kind of changing the fundamentals. That's just distorting premium.
Okay.
But it kind of goes in the whole stockpiling argument. So when I talk about stockpiling, I'm talking about countries that are worried about critical materials and that type of stockpiling. What you're talking about there with the tariffs is stockpiling in a different location because of a fear of tariffs being imposed. But it's kind of within the same bucket. So you add in the stockpiling, which is countries presumably thinking, oh, we need to supply more of our domestic industries with critical materials and let's stockpile that. That could be 400,000 tons a year right there. And then you add on defense spending, 200,000 tons. Data centers, maybe 400,000 tons. Now, these are extremes.
Yes.
All of that's not going to happen. But we've got a 300,000 ton deficit in copper. So if you added on those three things that I just said there, you'd have about a 1 million ton deficit. That's not going to happen, but that will be the biggest deficit we've seen in a very, very long time.
So the miners are adjusting to this. Where could additional supply come from?
Well, it can't in the short term because, you know, these mines take 5-10 years to come online. So this is part of the problem. But, of course, that's why you need higher prices to incentivize more production to come online. So it will resolve itself, but it's choppy as it does it.
Oil has been under pressure, $61 right now, so up 0.2%. There's all sorts of factors playing into it. Venezuela has been the key story of the week, of course. As you look into 2026, what are you targeting around oil?
Down towards 50 by the end of the year. I mean, I think pretty much the whole consensus is that we're massively oversupplied. The thing that's been holding oil up is Chinese SPR buying, which nobody really factored in the extent that they've been doing that. You know, anywhere between 500,000 and 1 million tons a day, barrels a day of oil demand coming from SPR, which is roughly...
So those are the sovereign reserves, China's sovereign reserves, and that's putting a floor under prices?
SPR and commercial reserves.
Okay.
So this is energy security that is putting the bid under the oil price. But what they're buying on a daily basis, which isn't real demand, is roughly equal to what the demand growth is going to be next year. So that's what's keeping oil up. Now, when that stops, when they fill up, that's when the party's over for oil and it drops down towards 50.
And they stop next year?
That's the expectation. I mean, they're building more and more SPR storage facilities, but the expectation is it ends sometimes next year. Originally, we thought it would be March, but I think it goes beyond that.
The Saudis respond to $50 a barrel on Brent.
Do they respond?
Do they? I mean, they're going to respond, surely. The OPEC Plus are going to have to take more barrels off the market.
This is our expectation is by April, when their pause ends, they're going to have to cut. That's my opinion.
So OPEC Plus cuts in April?
Yeah, because what happens is as oil drops in the first part of next year, US shale really takes a hit.
Yeah.
That's what the Saudis want. They want to see that finished, and then they'll cut to restore prices.
Okay, they want to take out US shale. They're giving Trump the lower oil prices he wants, but at the cost of his beloved shale industry as well. There's the conundrum.
Trump wants the consumers better off next year, midterm elections, so
he'll take the hit to US shale.
He'll take the hit to US shale.
4,300. Look at that, 4,300 now per troy ounce for gold. So up 0.7% in the session today. You see $5,000, as did our previous guest on the show, by the end of 2026.
Yep.
What are the factors that get us there?
Well, central bank buying, obviously, ETF buying. The one side that we haven't talked about, people haven't talked about, is jewellery demand. That's the only normal market right now, in the sense that as prices go up, people buy less jewellery. So,
are we seeing that now?
Yes, so the elasticity is normal. In other words, prices up, demand down.
Yes.
The elasticities, if you want to get technical here, on central bank buying and ETFs, you would expect them to be also negative. As prices go up, they stop buying, but they don't. So it's all broken. But the reason is because they're the reason that prices go up. So there's this causal linkage. So as they buy more, prices go up. So it appears that the elasticity is broken and they buy more when prices go up. But that's really what's going on.
You didn't talk about Fed rate cut expectations.
That's important too.
That is important. But if we don't get the kind of dovish moves from the Fed, the picture in 2026 after the FOMC decision this week looks very murky indeed.
Yeah.
Fine, we may have a new dovish Fed head, but we've seen the reaction from some of the regional Fed governors, more hawkish.
Yep.
If we get one more cut next year, does that derail the picture for gold? Does that
Our
put a dampener on
expectation is 2 cuts.
Okay. Do you need 2 cuts to get to 5,000?
No. I think this is all very secondary to the gold market. I think all the attention is on uncertainty, which is what drives ETF flows, and central bank buying, which will pick up again, I think, throughout this winter, because you do get seasonal lulls in central bank buying throughout the summer and into October. So it should start to pick up.
Okay, Michael Haig, thank you very much indeed. We did the tour, starting with copper, oil at $50 a barrel on Brent by the end of 2026, gold at $5,000 per troy ounce by the end of next year, and copper has further to run.
It does.
What level can copper get to before we wrap this up?
Well, we thought it was going to be 12,000 next year when it was 10 grand in September. We're already there. So our next leg up is 12,500.
It's about 2,500. That would be 12,500 on copper by the end of 2026.
Yep.
Michael, fantastic. Thank you very much indeed. Michael Haig, Head of FIC and Commodities Research at SocGen CIB. Let's get back to the tech story right now, because the chief executive of ASML has told me that Europe needs to do more to attract semiconductor companies if it's to have any hope of catching up in the AI race. ASML is Europe's most valuable company, producing the machines that make the chips designed by companies like Nvidia. I spoke exclusively with Christophe Fouquet at the company's headquarters in the Netherlands.
If you look at the overall AI ecosystem in Europe, it's very weak in any way you look at it. And, today there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind. And it's true with semiconductor, right? If you look at semiconductor, basically, take our shipment. The shipment of our system to Europe today is maybe 1 or 2% of our total business. And that's been the case for the last 10 years. So there is no buildup of semiconductor manufacturing in Europe. Not advanced, not mature. Why is that? Is because there is also no consumption of semiconductor in Europe. Most of the consumption, as I said, of advanced chips are in the US because the company that develop the AI chips are not here. So Europe is behind, and to catch up, Europe has to create the condition basically to attract this entire ecosystem back to Europe. And that's a major task, to be honest.
Because we have the engineers, we have the researchers, we have ASML.
Yeah.
But Europe does not own the chip space.
Well, we have the engineers, we have the researcher. I would say we have the market. I think the European market is a great market.
The ASML CEO, Christophe Fouquet, speaking to me for the latest episode of Bloomberg Tech Europe. You're going to be able to watch the full episode on the programme's YouTube channel. You can find it on Bloomberg.com as well. Now, Bulgaria faces a fresh wave of political turmoil just weeks before the country joins the euro. After steep protests over rampant corruption, the country's prime minister has stepped down after less than a year running a minority government. Joining me now from Sofia is Bloomberg's Slav Okov. Slav, talk us through the situation, how it escalated to the point where the prime minister felt the need to resign.
Hello. First, it's good to know that the political crisis is not something new to Bulgaria. It has faced 7 elections since 2021, which is making it pretty much unique. What is new is that this time the perception of corruption and state capture has triggered the biggest street demonstrations in many years. Now, the tipping point was a proposed budget for next year, which was increasing spending and some taxes. And to many protesters, that actually means that this increased spending only allows the ruling class to increase its control over public institutions, particularly the police and the security sector. So it's a way of the government to control more of the public sector this way. So it started with a budget bill, but essentially those protests were protests against corruption and for rule of law, a problem which is not new to Bulgaria. And eventually they reached the point at which the government decided that the most wise way is to resign.
Yeah. So talk us through the significance of the resignation then, and what it could mean in terms of how Brussels is looking at this as we approach that deadline around joining the euro.
Now, the first thing to keep in mind is this is not going to threaten Bulgaria's euro adoption in any way. So this is pretty much a technical process for which the country has been preparing for quite a while, and it's going to enter the eurozone smoothly, regardless of whether this is with the regular government or an interim government that could eventually step in maybe in a month or so. So in that sense, Bulgaria is not threatened of not joining the eurozone, and also Bulgaria itself is probably not the Eurozone's biggest problem, considering the fact that it's a country with very low debt levels and very low deficits, something that is not typical for many countries inside the Eurozone itself. That said, Bulgaria's tale is probably a cautionary tale for the EU's plans for enlargement in the future, considering the fact that The EU may have helped people in the country become richer, but it hasn't helped resolve the old problem with rule of law, which people are protesting against.
OK, Bloomberg's Slav Okov, thank you. An important update, of course, from Sofia out of the Bulgarian political situation as that country, of course, heads to the adoption of the euro. Now, back to technology. The head of Microsoft's AI unit says he is keeping a close eye on the growing number of circular deals being made by AI companies and their backers. The investments, notably involving Nvidia and OpenAI, have raised concerns from some investors. Microsoft, of course, has a significant stake in OpenAI. Mustafa Suleyman, who co-founded AI lab DeepMind before joining Microsoft, spoke to Bloomberg's Michelle Hussein about the agreements.
Obviously, customers and providers have often invested in one another and, you know, provides good stimulus to get us going. But it's something to watch. I'm definitely watching it carefully, and I think others are too. So, you know, I think that, getting the balance right is very important. We have to deliver in the next few years. I mean, every team now is building incredibly large, very powerful computers, and we're taking a huge bet that we're going to be able to convert this into true intelligence. And if we do, then I think the world is going to look very, very different. I mean, we will have abundant intelligence on tap. And I think people still underrate how phenomenal that is.
Well, you can listen to the full conversation between Michelle Hussein and Microsoft's Mustafa Suleyman. Just search the Michelle Hussein Show wherever you get your podcasts. Now, from Pop Mart's Labubus to Shein, we're switching tack here. Temu and Luckin, Chinese labels are now global consumer favourites and cultural flag bearers. Bloomberg Originals has been looking how geopolitics is now reshaping the rise of China's soft power.
Shoes, phones, windows to alternate realities. Many of our favourite products are made in China, but designed elsewhere. Well, that narrative's beginning to change a bit.
Pop Mart shares rise to a record as the CEO announces a new mini Labubu.
And the Game Award goes to Black Myth Wukong.
In the past, China was creating all these low-value products, and it's very hard to gain soft power from that. But as you move up the value chain, the natural byproduct is that your soft power also increases.
We will continue to actually see more of them penetrating into various overseas markets.
As the power of China in the global economy has increased, it's an opportunity for them to go and invest in these other markets, similar to the way that American companies probably did in post-war America.
Although no one's saying that's going to be smooth sailing.
A lot of the challenges for Chinese brands, especially in the US, depends a lot on the political uncertainties that have been unfolding under Donald Trump.
Some are locked out of whole markets, while others have invited a certain kind of rhetoric.
The Chinese government has that data.
So with Chinese brands seeming to win over global consumers, could they also help with something much less tangible?
What we're seeing now is an emergence of Chinese soft power into the rest of the world.
Well, subscribers can see that documentary in full right now on the terminal or at Bloomberg.com. It will also be available later on the Bloomberg Originals YouTube channel. Coming up, we will discuss the role of regulators in driving growth and innovation with Nike Trust from the UK FCA. That is next. This is Bloomberg. Welcome back to The Pulse. Now, former UK Prime Minister Theresa May has blamed social media for the rise of populism. In a wide-ranging interview on Leaders with Francine Lacqua, May said that politicians are losing the ability to compromise, which she sees as central to governing.
I think it is easier for populism to rise in a world where there is social media. In the past, you'd have old Joe sitting on the end of the bar in the pub, muttering into his pint of beer, and nobody took any notice of him because his views were either too extreme or too silly or ridiculous. Now old Joe mutters on social media, and all the other old Joes around the world respond, and suddenly it becomes a worldview. And when you get algorithms pushing people towards the sort of thing they want to see, and have looked at and heard a lot, then it becomes much more difficult because people are not seeing the other arguments. And actually, in life, in politics, in government, very often you need to be able to mediate, to compromise. And in that absolutist world, that polarised world, compromise becomes a dirty word, and it isn't.
What do you think the new world order looks like?
Well, at the moment, I think what we need to make sure is that we don't just move into a world where power, strong men, and when people think about it, they will think about it as strong men, is the order of the day. And it's multilateral institutions that were set up in the 20th century. They need reform. They need to look at where we are today and how we can make sure that we can have that sense of the value of multilateral work and find structures in which to take that forward.
Well, the full interview is out now on the Bloomberg website, of course, and on the terminal. You can also watch it on Bloomberg TV at 5:30 p.m. here in the UK. Staying with the UK, the Financial Conduct Authority is planning to change rules to make it easier for Britons to invest their own money in the markets. The UK watchdog is looking to follow the government's lead in encouraging households to shift more cash savings into the financial markets. Joining me now is Nikkei Trost, head of wholesale buy-side department at the FCA, the Financial Conduct Authority. Nikkei, thank you very much indeed for coming into the studio. So what is going to be needed practically to get people in the UK investing more of their cash into the markets? Does it require a cultural shift? And what are the practical steps that can be taken to get us closer to that point?
Yeah, one of the things we think is needed as part of that is that people need more support with their choices. And the package we announced yesterday on a measure called targeted support is really there to drive that. So at the moment, a regulated firm can help explain to you what different types of investments are or what an ISA is, all of those good things. But when it comes to saying, OK, and now where do I invest? Actually, they stop short of that, because then you're in the space of advice. And we're changing that.
You get that disclaimer. Up until yesterday, you get that disclaimer, don't you?
And you get that disclaimer.
And when you're on the phone with them, they say, we can't give you advice.
And you might get really standardised information that's actually not very intuitive and not very engaging. We're changing all of that. So we're creating a new form of support where firms will be able to say, look, for someone like you, with your characteristics, having done a bit of information gathering on you, this is a good product to invest in. And also, we're changing how firms can talk to their customers. We've abolished the really formulaic rules that existed so far. And now you'll be able to communicate in a way that's good for the end consumer.
What would the proof points need to be for you to take a step back and say, OK, these changes have worked?
Yeah. So at the moment, there's a really high number of consumers sitting in cash and not even thinking about investing. We've deliberately not said that number needs to change by X or Y, but we do want to see more engagement and we want to see more consumers thinking about their options.
There was a lot of focus, of course, in the run-up to the budget about what was going to change around ISAs and whether or not we get a UK ISA, so pushing people into investing more in UK equities. We didn't get that eventually. We got some changes around cash versus stocks, but not a UK-specific ISA. Do we need to get there eventually? Do you want to see more in terms of directing capital into UK-listed companies?
Well, I think tax and ISA changes, that's clearly a question for the government. But I think where our role in this is to really encourage a sustainable investment culture and a long-term sustainable investment culture.
Which parts, for you right now, when you look across the financial services industry in the UK, which parts are looking most ripe for reform?
Well, I think we think that in this space of support for retail consumers and supporting better investments, there is lots of room for changing how things are done. I think we've set the foundations here, and now it's over to firms to do that. But we've also done quite a lot, and we will continue to do a lot next year to slim things down for wholesale markets. You know, the UK is a huge financial services centre, and we want that to continue. And part of that is ensuring that our regime is really streamlined so that it's easy to do business here. Are
you seeing resistance? Where are you facing the most resistance? There must be some pushback.
I think people worry about the trade-offs that we make around that. And, you know, our work on targeted support is a good example of that, because, you know, if you don't get advice that's fully tailored to you, but for groups of people, well, it might be not entirely perfect for you. But that's a trade-off we think we need to make, because if you're sitting in cash and you've got a 20-year investment horizon, you're also taking risk. You might not know about it, but you're also taking risk. So I think an important part, you asked me, the pushback is an important part of that, is having a really mature conversation about trade-offs and risks and how to think differently about risk.
How are you thinking about artificial intelligence when it comes to regulating around this? How front of mind for you and the team is AI, and how that may be incorporated into financial services in the future?
And we are doing lots of work with industries through our sandboxes, through our innovation hub, to try out how AI can help. We've got some very exciting developments in that area, but I think we will see how that will evolve.
Are there areas that you think, because we're talking here about regulating for growth, are there areas where you see there need to be more regulation to stem risk? I don't know if that's in the crypto space or elsewhere. Are there points of the financial services industry you're looking at right now where there's some red flags around the need for more guardrails?
I think one of the areas where we always think we need to consider where we might need more is around the question of data and really understanding where financial stability risk is. I think that's something where we just need to modernize how we do things.
We think about financial education. There's arguably, objectively, a lack of financial education in the schooling system here. A lot of people go to social media now. Young people, are particularly TikTok. Some of that can be helpful. Some of that can tie into what you're trying to do, which is encouraging people to move at least some of their assets out of cash into higher performing assets if they have that long-term view. But there's also a lot of misinformation as well.
Yeah.
Is that something the FCA is looking at?
Absolutely. It's something we spend a lot of time on. And I think in the context of targeted support and advice, it's one of the reasons why we think it's really important that it has a regulatory badge so people can trust the recommendations they get.
So you provide regulatory badges to influencers on TikTok, for example?
No, we provide authorization for firms that have applied.
Oh, for firms that do that. Okay.
Different.
Okay.
And, you know, in the influencer space, we've done a lot of work with influencers actually to ensure that we get to good outcomes, good information.
Okay. Nikkei, thank you very much indeed for coming in, talking through some of the changes that the FCA is working on. Nikkei Trost, head of the wholesale buy-side department at the Financial Conduct Authority. Up next, counting down to Bloomberg Brief, checking your futures for you stateside. You're down on the S&P E-minis by just over 0.1%. Nasdaq 100 futures off by 0.5. It's been a decent session in Asia and Europe. It seems the mood is changing as we lead into the US. The Brief is up next. This is Bloomberg.